So this morning, this month's CPI report just dropped and markets rallied in response, and that's because the number came in lower than expected. You can take a look at the numbers on screen here. CPI month over month came in at 0.1% actual versus 0.2% expected. And of course, ex-food and energy year over year came in at 2.8% versus 2.9% expected. But here's what the vast majority of Americans don't seem to understand. Look at those bottom two numbers you could see right there. They actually rose compared to the prior, which you could see all the way over here on the right. So this is called disinflation in the top, when the rate of change of price appreciation slows down. But the key here is that that's not a deflation. It's not a reversal. It's just a slowing of the pace. Prices are still going up. Let's explain this. So imagine the price level as a car driving down the road. Now think of CPI inflation, the numbers that you just saw, as the speed of that car. If CPI inflation is 9%, the car is flooring it. And if CPI slows to 3%, the car is just easing off the gas. But unless CPI inflation goes negative, that car never reverses. So even with 2.4% year over year inflation, which we have now, prices are still climbing, just more slowly. A gallon of milk going from $3 to $3.27 instead of $3.30 isn't victory. It's just a slower loss. And this is exactly where the clever misdirection comes in. The public hears inflation is falling and assumes that means prices are dropping, but that's not the case. The price level is still rising. The dollar is still losing value. So why does this happen? It's because we're hooked on debt-fueled spending. Tariffs, deportations, and other political debate are sideshows. And ultimately, this whole doom and gloom about the dollar collapsing is pretty sensationalist. And of course, tariffs and deportations didn't cause that to happen. They didn't cause an inflationary spike. But the real game is this. The government borrows endlessly, and the central bank, the Federal Reserve, backstops it. That puts more dollars into the system and devalues the ones that are already there. That's the hidden tax of inflation. That's what this CPI number shows you. You might not see it line itemed on your pay stub, but it's there. Every time you buy groceries, you pay rent, or fill up your car. So take a look at this chart. This is a chart of Bitcoin in orange, global M2 in teal, and home prices in dark green. As global M2 climbs, meaning more paper money in the system, home prices rise too. That's monetary inflation in action. But only one asset outpaces the rise in money supply over the long run. Reliably. That's Bitcoin. Not real estate, not equities, not gold, right? Real estate and gold are relatively scarce. Equities, of course, are not. They could be issued ad infinitum. Just Bitcoin, because Bitcoin doesn't inflate. It doesn't bend to central bank policy. Its supply is capped, it's fixed, and immutable. And that's why it's the ultimate hedge, not just against CPI, but against monetary debasement, aka money printing. So what should you take away from this? Don't get fooled by the headlines celebrating disinflation or the price action in markets celebrating disinflation. Unless CPI is negative, prices are still rising. The dollar is still falling, and your purchasing power is being chipped away slowly and silently. This isn't about monthly data. It's about generational preservation, and Bitcoin is the only asset that reliably protects you from perpetual monetary expansion. It is the escape hatch, and it's time to climb into it. That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to like and, of course, follow and reshare for more so everyone can see this. And, of course, check out Horizon. At Horizon, we allow you to diversify a portion of your home equity into Bitcoin with no monthly payments and no share in the Bitcoin upside. You can check that out by scanning the QR code right there or going to joinhorizon.com. That's all for today. Thank you so much for watching. I'll talk to you soon.